In early 2026, the world of finance is almost unrecognizable compared to just a few years ago. The pace of change has been staggering, and the influence of digital currencies is now impossible to ignore. Cryptocurrency, once dismissed as a fringe experiment for tech enthusiasts, has become central to global economic conversations and strategies. What was once considered a risky bet is now a pillar of modern finance, shaping the way businesses and individuals think about money. In boardrooms and government offices around the world, digital assets are debated as seriously as traditional stocks and bonds. Leaders are rethinking regulations, investment strategies, and even the very definition of currency. The language of blockchain and decentralized finance is now common not just among financial professionals, but also among everyday savers and investors. People from all walks of life are learning how to navigate this new digital landscape. Blockchain's promise of trust and transparency is being realized across industries, from global supply chains to real estate transactions. Smart contracts are streamlining deals, and digital ledgers are making it easier to track goods and verify ownership. The shift isn't just about a new asset class, it's a technological and philosophical revolution. The very foundations of how we exchange value and build trust are being rewritten in real time. We're no longer asking if crypto will survive, but how it will be integrated into our daily lives. From buying groceries to paying bills, digital currencies are becoming a routine part of everyday transactions. Of course, regulatory and security challenges remain. Governments and cybersecurity experts are working to keep pace, developing new frameworks and protections. But the momentum toward a digital-first financial system is undeniable. Crypto is at the heart of this transformation, ushering in a new era for money, ownership, and the way we interact with the global economy. The future of finance is here, and it's more digital, open, and interconnected than ever before. Banks once dismissed Bitcoin as a threat, an unpredictable disruptor that could undermine their authority and business models. For years, the world's largest financial institutions scoffed at the idea of decentralized money, warning clients to stay away from what they called a speculative bubble. But now, in 2026, the tide has turned dramatically. Not only have banks stopped fighting Bitcoin, they're actively embracing it, integrating digital assets into their core offerings and forging partnerships with crypto innovators. Financial giants like BlackRock and Fidelity now recommend crypto allocations in client portfolios, treating Bitcoin and Ethereum as essential components of a modern investment strategy. The real turning point? Spot Bitcoin and Ethereum ETFs made digital assets accessible, transparent, and compliant for even the most conservative investors, opening the floodgates for mainstream adoption. Even former holdouts like Vanguard, once skeptical of crypto's long-term value, now offer a full suite of crypto ETFs, signaling a major shift in institutional attitudes. Banks are building digital asset divisions from the ground up, hiring blockchain experts, and using the technology to streamline everything from settlements to compliance, making their operations faster and more secure. The narrative has shifted completely. Ignoring crypto is now seen as riskier than embracing it. Bankers who once doubted are now racing to catch up, fearing they'll be left behind. Institutional adoption has brought a new level of stability, with pension funds and endowments balancing out the volatility once dominated by speculative traders and retail investors. This influx of serious, long-term capital is legitimizing crypto in the eyes of regulators and the public, encouraging more participation and paving the way for clearer, more supportive regulations. The institutional stampede is reshaping the entire financial landscape, making crypto a permanent fixture in portfolios, boardrooms, and everyday transactions. The landscape is fundamentally altered. Crypto is no longer an outsider, but a core pillar of the new financial world. While Bitcoin grabs headlines as the face of cryptocurrency, it's stablecoins that are quietly transforming how people interact with digital money every day. Stablecoins are the real engine of crypto's mainstream adoption, bridging the gap between traditional finance and the blockchain world. Pegged to assets like the US dollar or euro, stablecoins act as digital dollars on the blockchain, offering the familiarity of fiat with the innovation of crypto. They enable instant, low-cost global transactions, bypassing traditional banks and eliminating the delays and high fees of cross-border payments. For businesses and investors, stablecoins offer liquidity, a stable store of value, and a way to hedge against the volatility of other cryptocurrencies within the crypto ecosystem. This fluidity powers the explosive growth of decentralized finance, DeFi, where users can lend, borrow, and earn yield, all without relying on traditional banks or intermediaries. Underpinning it all is blockchain technology, a distributed, immutable ledger that ensures transparency, security, and trust in every transaction. No single entity controls the network, and every transaction is publicly verifiable, making fraud and manipulation nearly impossible. This trustless infrastructure is the backbone for tokenizing assets, moving trillions of dollars on-chain, and unlocking new possibilities for global finance. Together, stablecoins and blockchain are quietly building the new financial plumbing for the digital age, making money more accessible, efficient, and borderless than ever before. They're the unsung heroes making crypto reliable, practical, and ready to scale for billions of people worldwide. 2025 was a roller coaster for Bitcoin, soaring to $126,000 before a brutal crash. Optimism and institutional interest fueled a record bull run, but a sudden liquidity crisis triggered a flash crash and wiped out billions. The market's resilience was tested, but institutional infrastructure held firm. Excessive leverage was purged, and the importance of risk management became clear. The crash exposed systemic risks and sparked calls for more decentralized market structures. By year's end, Bitcoin had pulled back, closing down 6% from its peak. Investors entered 2026 cautiously, watching key support levels. Despite volatility, major institutions remain bullish on crypto's long-term future. The turbulence was seen as growing pains, not failure. The market emerged stronger, with firmer foundations for what's next. Bitcoin's wild ride ultimately reinforced its place in the financial system. The crypto economy is being shaped by bold leaders and innovative companies. Michael Saylor's MicroStrategy pioneered the corporate Bitcoin treasury, leveraging its structure to accumulate more Bitcoin. American Bitcoin, backed by figures like Eric Trump, is making the US a mining powerhouse by tapping cheap energy. Coinbase is evolving from an exchange to a full on-chain ecosystem, building the infrastructure for decentralized apps. Companies like Hut 8 and Galaxy Digital are merging energy, mining, and AI, flexibly allocating resources to meet demand. These firms are redefining what it means to be a tech company in the digital age. The convergence of crypto, energy, and AI is creating new business models and opportunities. These new titans are building the backbone of our digital future. Tokenization is transforming ownership in 2026. By creating digital tokens for real-world assets, stocks, real estate, art, blockchain makes them tradable, divisible, and accessible. Fractional ownership lets anyone invest in assets once reserved for the wealthy, like skyscrapers or fine art. Tokenized stocks and bonds now trade 24/7, bypassing traditional market hours and borders. Visionaries are pushing boundaries, with ideas like tokenizing iconic buildings or creators' future earnings. Asset owners gain new ways to raise capital. Investors get unprecedented access and flexibility. Every transaction is recorded on an immutable ledger, boosting transparency and efficiency. The shift from physical to digital ownership is a cornerstone of the new economy. Nearly any form of value can now be represented and traded on-chain. In 2026, AI and crypto are converging, amplifying each other's strengths. Both demand massive computational power, leading companies like Hut 8 to build flexible energy infrastructure for mining and AI. This synergy turns energy consumption into a strategic asset, supporting both sectors' growth. Blockchain solves AI's data authenticity problem by providing verifiable audit trails for training data. Trust in AI systems grows when data provenance is guaranteed. AI is also enhancing crypto, designing financial products, detecting fraud, and predicting market moves. But AI also powers more sophisticated scams, making security a constant battle. The convergence is a double-edged sword, but it's driving smarter, more secure decentralized systems. Together, AI and crypto are building the next generation of digital infrastructure. As crypto goes mainstream, regulators are racing to keep up. The US is moving toward clear rules, with the Clarity for Digital Assets Act promising much-needed certainty. Globally, countries are embracing crypto, creating frameworks to attract innovation and investment. But rapid growth has fueled a surge in sophisticated scams. especially targeting individuals' wallets. Criminals use phishing, malware, and social engineering to steal assets, shifting security responsibility to users. AI supercharges these scams, enabling deepfakes and automated attacks at scale. The battle between innovation and exploitation is intensifying. Industry and regulators must work together to educate and protect consumers. Security is now a personal and collective responsibility in the digital asset world. In 2026, crypto's integration into daily life is inevitable. The line between traditional and digital finance is blurring, creating a unified, always-on system. Tokenization will accelerate, bringing more assets on-chain and making markets global and accessible. AI-driven security and blockchain-verified data will make digital systems more trustworthy. Challenges remain: volatility, regulation, and AI-powered scams. But the direction is set. This transformation is about more than investing. It's about building a more open, accessible financial system. Individuals gain more control, and entrepreneurs have a global platform to innovate. The digital future is being built now, one block at a time, shaping generations to come.